a substantial investment portfolio, and a disciplined approach to saving and investing. By considering factors such as dividend yield, diversification, reinvesting dividends, tax implications, and your expenses, you can increase your chances of successfully living off dividends. Investment size. To generate enough income from dividends, you need a significant amount of capital invested in dividend-paying stocks. The exact amount depends on your annual expenses and the average dividend yield of your investments. Let's break this down further. When we talk about generating income from dividends, we're essentially discussing a strategy where your investments work for you, providing a steady stream of income. This is particularly appealing for those looking to achieve financial independence or retire early. The first step in determining the right investment size is to understand your annual expenses. This includes everything from your mortgage or rent, utilities, groceries, healthcare, entertainment, and any other recurring costs. By having a clear picture of your annual expenses, you can set a target for the income you need to generate from your investments. Next, consider the average dividend yield of the stocks you're interested in. Dividend yield is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. For example, if a stock is priced at $100 and pays a $4 annual dividend, its dividend yield is 4%. To calculate the amount of capital you need, divide your annual expenses by the average dividend yield. For instance, if your annual expenses are $40,000 and the average dividend yield of your investments is 4%, you would need $1 million invested in dividend-paying stocks to cover your expenses. It's important to note that dividend yields can vary significantly between different stocks and sectors. Some sectors, like utilities and consumer staples, tend to have higher dividend yields, while others, like technology, may have lower yields but higher growth potential. Diversifying your investments across different sectors can help balance risk and return. Additionally, consider the impact of taxes on your dividend income. Depending on your country and tax bracket, dividends may be taxed at different rates. It's crucial to factor in these taxes when calculating the net income you'll receive from your investments. Another aspect to consider is the potential for dividend growth. Some companies have a history of increasing their dividends over time, which can help your income keep pace with inflation. Researching and selecting companies with strong dividend growth records can be a valuable part of your investment strategy. Finally, remember that investing in dividend-paying stocks is just one part of a comprehensive financial plan. It's essential to have a diversified portfolio that includes other asset classes, such as bonds, real estate, and cash, to manage risk and achieve your long-term financial goals. In summary, determining the right investment size for generating dividend income involves understanding your annual expenses, calculating the required capital based on average dividend yields, considering taxes, and selecting stocks with potential for dividend growth. By carefully planning and diversifying your investments, you can create a reliable income stream to support your financial goals. Dividend yield. The dividend yield is the annual dividend payment made to shareholders by a company, expressed as a percentage of the stock's current price. It is a key metric for investors who are looking to generate income from their investments. Essentially, it tells you how much cash flow you are getting for each dollar invested in an equity position. For example, if a company pays an annual dividend of $2 per share and its stock is currently trading at $50, the dividend yield would be 4%. This figure is crucial for income-focused investors, as it helps them compare the income-generating potential of different stocks. The dividend yield is calculated by dividing the annual dividend payment by the stock price. Higher yields can provide more income, making them attractive to investors who rely on dividends for a steady income stream. However, it's important to note that a higher dividend yield can sometimes be a red flag. It might indicate that the stock price has fallen significantly, which could be a sign of underlying problems within the company. Therefore, while a high dividend yield can be appealing, it is essential to conduct thorough research to understand the reasons behind it. Higher yields often come with higher risk. Companies that offer very high dividend yields may be doing so because their stock prices have dropped due to poor performance or other issues. This can make them riskier investments. On the other hand, companies with lower, more stable dividend yields are often more reliable and have a history of consistent performance. A balanced portfolio with a mix of high yield and stable dividend stocks is usually recommended. This approach allows investors to benefit from the income provided by high-yield stocks, while also enjoying the stability and lower risk associated with more reliable dividend payers. Diversification is key when it comes to building a robust investment portfolio. By including a variety of stocks with different dividend yields, investors can mitigate risk and enhance their potential for returns. For instance, including both high-yield stocks and those with stable, lower yields can provide a balance between income and growth. Additionally, it's important to consider the overall financial health of the companies in which you are investing. Look at factors such as earnings growth, payout ratios, and the sustainability of their dividend payments. This comprehensive approach can help ensure that your portfolio is well positioned to weather market fluctuations and provide a steady income stream over the long term. In conclusion, while the dividend yield is an important metric for income-focused investors, it should not be the sole factor in making investment decisions. A high dividend yield can be enticing, but it often comes with increased risk. Therefore, it's crucial to conduct thorough research and consider other factors such as the company's overall financial health, market conditions, and your own investment goals. By taking a balanced and diversified approach, you can build a portfolio that not only provides a steady income, but also has the potential for growth and long-term success. Diversification. Diversifying your investments across different sectors and companies can help mitigate risk. This way, if one company cuts its dividend, it won't drastically affect your overall income. Reinvestment. Initially, reinvesting dividends can help grow your portfolio faster. Once your portfolio reaches a sufficient size, you can start taking the dividends as income. Tax considerations. Dividends are often taxed at a lower rate than regular income, but it's important to understand the tax implications in your country and plan accordingly. Living expenses. Your ability to live off dividends also depends on your lifestyle and expenses. Lowering your expenses can make it easier to rely on dividend income. Don't forget to like, share, and subscribe to my channel.